When you're picking stocks, you're trying to get the best bang for your buck. Stick around to see ways to identify undervalued stocks. How's it going, guys? Ryan here, and welcome to another episode of Stock Market Basics. And today I want to talk to you about how you can identify stocks which are currently undervalued and cheap for you to buy and have lots of upside. This is an absolutely critical skill that you need to learn if you're going to be self-sufficient when you're investing. You need to know what to look for and what stocks are likely to increase in value so that you end up making a profit more times than you make losses. There are hundreds of ways to determine if a stock is undervalued, but today I want to share with you some simple ways to do that are pretty straightforward and easy to learn. So the first concept I want to talk about is current ratio. Now this is a really easy calculation to perform yourself. Essentially it is current assets over current liabilities. So when you perform this, you're essentially developing a ratio where you can see in comparison to the current liabilities versus the current assets where the company stands. The crucial number you're looking for here when trying to determine is this company cheap is 1.5. So when you put the current assets over the current liabilities, the number you want to return is 1.5. Anything higher than 1.5 is absolutely fantastic. In fact, the higher it is, the better, because it means that the company has significantly more assets than it does liabilities. Whereas if it's below 1.5 or if it's getting to quite a small number or negative, you want to really steer clear. Now, when we're talking about the current ratio being negative there, obviously you can't have a current ratio being a literal negative value, but we're talking anything below than 1, because that means the current liabilities exceed the current assets. Effectively, anything that falls into this category is likely in debt and the company is probably in dire straits and you want to avoid investing in them. Whereas if they are above the 1.5 or at the 1.5 level, they're looking pretty good. Hopefully you need to aim for something maybe above 2, give you a bit of headroom to grow the value of your share. The next thing you want to look at is the market cap, and this is probably one of the easiest indicators to use. And essentially what the market cap is the total number of shares on issue times by the current share price. For example, if you had 10 million shares on issue for a company and the share was valued at $1, that would essentially give a market cap value to the company of $10 million. And effectively, that's what people see as the value or the worth of the company. When you're looking at the market cap, you want to do a bit of study on the company you're looking to invest in. You want to see the current cash on hand, you want to see the current assets of the company, and effectively you want to see the future potential of it. Effectively, what you want to do is look at the current value of the company from a cash and assets and even a debt point of view and see what's the company worth in those terms, and then you compare the value of that to the value of the market cap of the company. In doing so, you'll effectively be able to determine whether the company is currently undervalued from a basis of what they currently have now versus what the company is currently being valued by the market at. If the company has a significant amount of money, let's say $20 million in the bank, but the company is only worth $10 million from a market cap perspective, that means that company should in theory double because they're worth double the amount of money, pending obviously they don't have any debt currently over their head. You also want to look at the industry peers or competitors of the company you're looking to invest in. What is their current intrinsic value? What are their market caps? Is the company you're looking at better than another company but its market cap's lower? That means in theory it should increase in value. If this is the case and the other company isn't significantly overvalued, you've probably got a good thing going for you if you're investing in this stock. If everything's looking like, hey, this company should be worth a lot more money, or you can see it being worth a lot more money in the future, then absolutely you should probably consider investing in that company. This leads on to the third element I want to discuss, which is, does the company have a strategy? Does it have a roadmap in place at this point of time? A roadmap or strategy will effectively allow you to see how the management of the company are planning to move forward into the future, how they're planning to grow the company and eventually or increase the current profit margins they're making. What you really want to be looking for here is, are there any additional assets that the company is going to acquire? For a mining company, for instance, this could be they're going to acquire projects, or they're going to start building a mine that's going to generate cash flow in the future. And you want to be seeing if these projects are going to be worth more in the future and generate the company a positive cash flow. You also want to be able to consider the other elements of the company roadmap, in the sense of, for these projects they're acquiring, for instance, how are they going to fund them? Is the company going to have to take on debt? Are they going to have to perform a capital raise, as a result diluting the shareholding? There's other elements you need to take into consideration, and in particular, funding is absolutely crucial when a company is trying to grow. In saying that, debt is not always a bad thing. For small companies and shells, often they need to take on a bit of debt to get something actually going. At the end of the day, you need money to grow a business, and the best way to do that is to take on loans or raise capital. Now, for the fourth one, we're looking more at established companies, and what we're looking for is consistent profit growth. When you're looking at more well-established companies, you expect them to be making a profit, and you expect them to have that profit consistently grow year on year. You want to be making sure that the company is going in the right direction, and as a result, the best way to look at this is the cash flow. In a growth period of a company, they can take a profit hit because a lot of the time they might be increasing their expenses because they're taking on new projects, taking on new staff. But what you want to see is the money they are making, they're putting it into good projects and areas that you can effectively see the company is going to make a profit in the future. So you're not necessarily looking at the current profit growth, but the potential future profit growth as well. Now, on the other side, you want to be seeing, okay, so we've got all this money in, but compared to the expenses, is that margin consistently growing? So if the expenses are growing, but the revenue coming in is not, generally you want to probably steer clear of that company if there's no good reason for it. So an example of that might be the company is effectively taking on more waste because they're not able to sell their produce, for instance, and they're having to dump their products. Another example might be a mining company's machinery is consistently breaking down, and as a result, the expenses to fix that and to maintain that are consistently increasing and encroaching on the profit. Now, most of the things you obviously want to look for are the fundamental indicators, which is what I've just discussed, but you can also look at the technical indicators to give you a good idea if a stock is cheap or not at the current price. The first and most obvious thing you want to look for is the company currently in an uptrend or are they in a downtrend? Obviously, you don't want to be investing in a company that is downtrending. You want to be investing in a company that has consistent increases in share price over a long period of time. Alternatively, you might be looking for when to enter a company that you think's cheap. You want to get in at the cheapest time possible. So what you want to do is basically maybe take the 50-day and 200-day moving average on a share that is downtrending. And then when the 50-day moving average eventually crosses above the 200-day moving average, then you can see there's probably been a momentum shift in the company's value. When you're looking for entry points, you might also want to consider the relative strength index, or the RSI for short, because effectively if this number drops below the 30 mark, then the current share you're looking at has been oversold. And as a result, it is likely to bounce in price because buyers should be coming in and it shouldn't be as low as it currently is in such a short period of time. I hope you guys enjoyed the video and it helped you with some ways you can potentially start learning how to identify cheap shares. If you did, please leave me a like. I really appreciate it. And if you have any questions, leave them in the comments section below. I'll get around to answering them. And if you want to see more content, please remember to subscribe. As always, guys, have an awesome day. See you next time.